the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares were roughly flat at around 2 p.m. today as investors continued to mull corporate earnings out of the country. So earlier back then, it was up 0.19 point for the STI at 3,916 points. With a value turnover of 950 million Sing dollars in the broader market. Now let's take you through the closing numbers. The STI ended 0.2% lower at 3,908 points. In terms of value turnover, we're looking at 1.65 billion Sing dollars. Gainers outnumbered losers 330 versus 236. Top advances for today, we've got here Jardine Cycle and Carriage, UOB and SBS Transit. And top decliners we've got for today OCBC, New Incorporation USD and Citrum. Now in terms of companies to watch, we've got for you OCBC. The lender today reporting a net profit of 1.69 billion Sing dollars for the fourth quarter ended December, up 4% from 1.62 billion Sing dollars seen in the previous corresponding period. Now elsewhere, from a tussle for control over property giant CDL to DeepSeek reopening access to its core programming interface after nearly a 3-week suspension, we've got more corporate and, of course, international headlines in focus. And joining me on the line for today is Jeff Ng, Head of Asia Macro Strategy at SMBC. Jeff, welcome.
Hi, good evening.
Great to have you. And Jeff, let's start with the Singapore stock market as usual. How did the STI fare today? Any surprises when we look at the biggest movers?
Well, when we look at the minus 0.2% in terms of the STI's performance today, it looks roughly within range compared to other trading days as well. And we've had some large gainers like Hong Kong Land and Jardine Cycle and Carriage, and then some losers from Citrum as well as OCBC. So some sectoral losses from some companies.
I see. And Jeff, let's zoom in on the trail of local banks because OCBC reported net profit of 1.69 billion Sing dollars for the fourth quarter ended December, which was up 4% from the previous corresponding period. But that being said, if we look at the counters movement, earlier it was down nearly 3% because the earnings came in below expectations. The final dividend was also slightly lower. So how did the trail of local banks fare in response today? What is the outlook for the banking sector as a whole going forward?
I think the outlook has been quite bright if you look at the banking sector and financial sector in general. So it could be a bit mixed in terms of individual performances. I think in terms of the Q4 financial sector performance, I think what we saw was quite a lot of elevated trading activity due to a huge shift in terms of the global as well as the domestic financial sentiments and developments. So I think that led to a lot of volatility. And I think that could have supported banks and fund managers in terms of the overall performance in the last quarter. And I think going forward to this year, right, when we look at the economic performance for Singapore, for example, we still anticipate that it could be supported by the financial sector. I think there's still stronger demand for cross-border transactions in the region, so that should boost some sectors like the payments processing activities. And I think the sector will still help to alleviate some of the downside risk to the manufacturing sector. So it will help, I think, Singapore's overall growth to be still around 2-3% this year after a strong performance of 5% year-on-year in Q4 2024.
I see. And another counter that's on the mind, on the top of investors' minds, Jeff, and that is CDL, City Developments Limited. Now, I do want to take some time with this one, so please bear with me. We are seeing a tussle between father and son for control of City Developments Limited, and this was revealed today as Executive Chairman Kwek publicly criticized his son Sherman Kwek, who is CDL's Group CEO. Now, a lot of background over here. So basically, the older Kwek said that he has filed court papers to address the attempted coup by his son, Sherman, board members Philip Lee, And if I have a quick look at CDL's board of directors page, I believe we're looking at Philip Lee Ji Cheng, who was an audit partner at KPMG Singapore, and Wong Ai Ai, as well as a group of directors acting with them to allegedly consolidate control of CDL's board. Some drama here, if you will, Jeff. Shares suspended this morning as well. The firm also called off its earnings briefing initially slated to take place this morning. I understand you do not comment on individual firms, Jeff, but generally speaking, what are the implications of such governance issues on SGX-listed firms, particularly when we look at investors' confidence over succession?
It looks like pretty specific news to individual company, but when we look into the whole overall macro picture in terms of the property sector, I think what we are seeing over the past few months is that there's been increased activities in the private residential, private commercial, as well as the industrial property sectors. I think it should be modestly positive in terms of the property sector going forward into 2025. I think when we look into the macro level, some may have been watching out for perhaps more cooling measures from budget 2025, as there may be some concerns that prices for properties may be too high. But I think what we do look for is, I think, more normalization ahead. There should be better balance in terms of the demand as well as the supply for properties going forward. And I think interest rate will also moderate further. So I think it may imply that conditions may be more normalized in 2025 compared to the imbalances we have seen post-pandemic.
And don't mind me following up, right, Jeff? I know you do not comment on company-specific news, but when we look at governance issues and the implications on SGX-listed firms, is it more or less still by a case-by-case basis, any precedents that we're looking at as well?
Yeah, where I cover on the Asia macro strategy space, right, I do look at, for example, government initiatives and government spending, for example, as a key differentiator for economic development in the region. So I think, in a very competitive multipolar world that we are seeing at this stage with US, China, all having competitive stances and strong performances, I think it's really up to individual government to really support the overall outlook. So I think to some extent, it could be a factor to gauge some of the relative economic performances that we're going to see this year compared to the past few years.
Okay, so right to say that governance issues still on a case-by-case basis. More broadly speaking, we still have a lot of macro tailwinds or headwinds that are influencing these property developers, yeah?
Yep.
Okay. Now, if you're just tuning in, we're in conversation with Jeff Ng, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. Well, let's stay in Singapore, Jeff. Singapore's manufacturing output grew 9.1% year-on-year in January, marking the 7th consecutive month of expansion. Now, the showing matched the median forecast of economists polled by Bloomberg, who had also projected 9.1% increase. How would you read into the latest numbers then, Jeff, in terms of the health of the Singapore manufacturing sector on a macro basis?
I think the main surprise for me this time around in terms of the industrial production and manufacturing numbers was that it matched analyst expectations, because sometimes the number is so volatile that it's very hard to be so accurate on a one-digit basis. So having it match does suggest that, number one, the economy is performing quite well, and secondly, I think expectations are also quite positive on the Singapore economy as well. I think with a 9% year-on-year growth for January for industrial production, it does set the stage for some positive growth for the first quarter. And I think that should help with economic growth, for example, for Singapore to stay close to the 2 to 3% range. And I think when we look into the deep dive of the breakdown, growth looks to have been supported by the ever volatile biomedical sector, as well as from the electronics cluster. Now, I think one area that I may be thinking of some slowdown going forward could be electronics, because there have been some front loading over the past few months as anticipation from, let's say, Trump policies or tariffs that may be coming into the picture. So growth in electronics may moderate, but we still see that biomedical may still support. And if you look at other clusters like transport engineering, they're still likely to expand at a healthy pace. So it all means that manufacturing may drag a little as we head into the second half of 2025, and growth may moderate, and we still need other sectors, the services sector, financial sectors that we talk about at the earlier part of the interview, to overall support the economic performance for Singapore.
And across the region, Jeff, DeepSeek has reopened access to its core programming interface after nearly a 3-week suspension. Now, what is worthy of note is that the resumption of the top-ups came on the day that Alibaba Group Holding launched a preview of its latest model called the QWQ Max, which sort of underscores that competition within China's nascent AI industry. What's your take on the move? And broadly speaking, what is the outlook for China's AI stocks then looking at the macro trends in AI?
Yeah, it looks like at the start of the year, the whole world has woken up to the fact that that China is indeed progressing in terms of the technological development, and there's been quite a lot of developments on the technology space which may not have been priced in by markets over the past few years. As markets were concerned about China's domestic momentum, as well as some idiosyncratic factors from China. I think we also noted that in the near term, sentiments both onshore as well as offshore, they have been improving. And I think when we look ahead, China growth will be there. I think China will still have its place in the world. And with looming tariff and headwinds from the US or from other economies, I think China will have to rely more on domestic demand going forward to meet its economic goals. We are anticipating that China still continues to have about 5% growth target for this year, which is similar to the economic performance last year. And I think technology will be a key focus. And I think what it all means for AI and technology space is that there will be more competition with other countries. And perhaps there will also be competing standards as well. So if we look at, let's say, the currency space where I focus a lot on, it also means that the dollar CNY may be a bit higher in the near term because if there's some tariff, the CNY may weaken against the US dollar closer towards 7.3 to 7.4 level from levels of around 7.25 at this stage before heading lower. So maybe some rebound in the Chinese yuan in the second half of the year as some of these concerns dissipate.
And a quick follow-up question, if you don't mind, Jeff. How important do you think the tech sector would be for China and helping it move away from that slump we've seen with regards to the economy in the past few years?
Indeed, I think it's an area where China is emphasizing on because I think China also realized over the past few years that you cannot rely on quantitative growth anymore. China growth is now reliant on maybe higher quality technological development. So I think that could continue to be a key focus. Perhaps this move into AI may also mean other developments, but like space, also on other chips, semiconductors. So yeah, all this provide a lot of opportunities for future growth potential in China. And I think in terms of the China growth story, we are also looking at perhaps more regionalization. So perhaps growth in the lower or the less developed areas in China catching up with those that are more developed.
I see. And finally, before we let you go, Jeff, all eyes are on Nvidia's earnings out later tonight in US time, or rather overnight if we go by Singapore time. I believe investors, they are looking out for a couple of things, namely revenue contributions from its Blackwell lineup and how the firm is getting around tariff threats and export controls, not to mention DeepSeek as well. What are you keeping your eyes on, and what clues can we then get on the broader tech sector in the US?
Yeah, in terms of the tech sector, I think what we realized from markets is that there has been a lot of positive expectations over the past year or so that tech will drive economic growth in the future as growth drivers shift, and there'll be a change in standards. And I think the technological development, because of the competition, is likely to accelerate over the next few years as well. Still, I think markets may move very fast. And the AI boom or the expectations for the AI boom may have moved ahead of market expectations. So it may mean that, in the near term, some of these expectations come off and some consolidation may be due. I think what we're anticipating is that in this technology development space, there will also be winners and losers. And we're also looking at some headwinds. For instance, Trump has already announced steel and aluminum tariffs, and he may move on to have tariffs on the semiconductor space or on electronic and electrical items or on motor vehicles. So all this may be pulling the brakes for this technology development in the near term or maybe even in the medium term. This uncertainty impact may also weigh on economic growth and investments due to some concerns over who will win this war, or perhaps over competing standards, as we mentioned previously as well. So in the near term, I think there's going to be quite a lot of uncertainty between expectations, between fundamentals, and between development. And I think what it also means on the dollar, where I track very much frequently, is that I'm still anticipating some dollar strength. It hasn't performed that strongly over the past 1-2 months, but perhaps the dollar could strengthen over the next 3 to 6 months period before weakening more discernibly in the perhaps latter half of 2025.
I see lots to watch indeed. Thanks so much for the insights, Jeff. That was Jeff Ng, Head of Asia Macro Strategy at SMBC. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.